right now, there's actually a big fight going on. There's a fight between people who think that the future is going to be a lot worse and people who think that like maybe we actually have hit a bottom and we're about to come back up. Now, me personally, I don't think that we've hit a true bottom, but at the same time, I've never really tried to say that I'm in the business of timing the market. I have an algorithm that times the market for me, and it does a much better job than me.
Sure.
So me, I'm looking at, what are these things going to be worth 2 years down the line, 5 years down the line?
You're still thinking long term.
Definitely.
All right, everybody, welcome to the Angel Research Podcast. I'm your host, Jason Stutman, and as usual, we are here to talk about the market's hottest stock stories, unique investment opportunities, and money-making strategies. We have Jason Williams on the show today. Jason is a repeat guest, but for people who haven't seen the other episode, the long and short of it is that Jason is a reformed Wall Street banker who is now an investment analyst for the retail community. And today we're just going to kind of be talking about some general economic trends. It's a pretty crazy market out there right now. I kind of like to call it the age of uncertainty right now. So hopefully Jason can give us a little bit of certainty. It's been the worst start of the year since the Great Depression. Retail investors are in a state of capitulation, and there's a lot of reasons for this. Let's start with the topic of inflation. Jason, how do you feel about inflation right now? Maybe what direction it's going? Is this something we should be concerned about?
All right. That's a pretty broad question. How do I feel about it? I don't like it.
Sure. Neither do I. I don't think anybody does.
I've always been one of those people that argued that, the Fed sets these target inflation rates and inflation is good. And I don't know. I mean, growth is good, but inflation doesn't necessarily have to be great. And the thing is inflation is high and it's been growing and people keep wanting to say that it's peaked. And, maybe it's peaked for the short term, but I really don't think it's peaked in the long term. We've got a Federal Reserve that caused this. We've got a government and a Federal Reserve that caused this. They printed tons of money. They just pumped money out into the economy. They threw gas onto a fire that was already out of control. And then, when they saw what was happening, they were like, nah, man, it's not that bad. It's fine. We've got this. Transitory inflation. Sure. It's not going to be that bad. And then when they finally admitted that, it wasn't transitory inflation and it was going to be sticking around. And just before I get into that, when I think transitory, I think that means something comes and then it goes, right? But what they meant is that it was transitory in that, that increase wasn't going to continue. But once prices rise, they usually don't go back down.
Sure.
You know what I mean? Unless a bubble pops or something.
Yeah.
But typically, once that increase is there, it's there. And, so that's not transitory to me, even if the increases had stopped. But we all knew that the increases weren't going to stop.
Do you think they just changed their definition of transitory after the fact, or is that really
totally.
What they meant from the beginning?
I can see them channeling, 1990s Bill Clinton with well, that depends on what the meaning of is.
Yeah, sure.
So it's just... It's kind of ridiculous. The Fed's the one that got us into this. And the reason that I sort of see, I see inflation continuing to build is because, the Fed, in order to get inflation to stop, has to cause a recession. Has to. They have to raise rates up above where inflation is.
Sure.
And so they're targeting, 3.5% by the end of this year, 4.5% by 2023, with inflation at almost 9%.
Yeah.
So, technically, in order to stop inflation, they have to get their interest rate up above the rate of inflation, which is 9%. So, we're talking about 10% interest rates. I just don't think this Fed has the chutzpah to do that.
Sure.
For lack of a better word for the internet.
Yeah, we're obviously kind of in this butterfly effect situation where, inflation is an issue and then the Fed responds by raising rates and then that is going to potentially throw us into a recession.
Mm-hmm.
So you think that a recession is pretty much inevitable?
I think it is. I'm not sure how long it would last though. You know, because I think that we're already in one. When it comes down to it, I think that we're already in one. When you go back and you're looking at the GDP estimates from the first quarter, they're for negative 1.4% growth. When you look at what the estimates are for the second quarter, which is ending this week.
Yeah.
We're recording this on Wednesday. The second quarter ends on Thursday the 30th, And, you know, if we don't have growth or if we had a little bit of negative growth, then technically that meets the definition of a recession. It's 2 quarters of backward progress.
When can investors expect that that data to come in?
That's usually like a month behind.
Okay.
So, you know, I mean, basically we'll be getting that sometime in July.
Okay.
But then also you think like this is June, you know, and we just got the most revised estimate for first quarter. And the first quarter ended at the end of March. So, you know, I mean, we'll continue to get revisions and things like that.
Sure.
But we'll start to see that real number in July. And so the Atlanta Fed has this thing called GDP Now, where it's basically a website where they put up what their forecast is for the GDP of the quarter that we're in. And they've been forecasting 0 to negative growth this entire quarter. So I'm thinking we're in a recession. But like I said, I don't know how long it lasts because I don't know that the Federal Reserve, you know, has what it takes to you know, like get through that.
Sure.
I wonder if they, you know, become data dependent again and they panic because the markets are tanking, the economy looks bad, you know, there's midterm elections coming up, and you know they either stop raising rates or they maybe even step back and lower them some, you know, because and you think about it, I talk about Paul Volcker and I'm like, oh man, somebody needs to do what Volcker did, but Volcker would raise rates by like 6% and then drop them by 6%.
Sure.
You know, he was trying to play that balancing act too, and finally, you know, he just sort of stopped playing the balancing act and put the rates up above inflation, and that's what capped inflation. It also caused a huge recession.
Well, I do think that's been one of the issues is that they've been so kind of like passive about this, and they're trying to like respond to the data slowly, but it's just like they're not acting quick enough, and that's kind of what has gotten us in this mess in the first place.
And trying to ride that line where they're balancing economic growth and lowering inflation, and what that makes me worry about is stagflation.
Sure,
you know, that's like, you know, it's a dirty word. People hate hearing it.
And what is stagflation exactly? Stagflation is just a period of inflation while unemployment is also high, or is
it's a period of inflation while the economy isn't growing or is shrinking.
Okay.
So basically you get stagnation, which is the lack of growth, and then inflation, which is, you know, the hikes in prices.
Sure.
And what can really lead to that is that wage price spiral, which we haven't really seen start yet.
Yeah.
But that's basically where, you know, prices go up so much that employees are like, look, man, I can't afford to buy anything anymore.
So they start
I need
demanding
a raise. And if you don't give me a raise, I'm going to quit, and you're not going to be able to run your business. So companies are like, all right, well, we'll give you a raise, but in order to pay for that raise, we got to hike the cost of our products.
Sure, and that's essentially how civilizations collapse, and so hopefully we don't go
man,
there.
Hopefully we don't go there. I mean, we definitely got into that in the 1970s, you know, during the last time we were in a state of stagflation.
Yep.
Funny because back then we also had an energy crisis. We seem to be in an energy crisis now. You know, Mark Twain's always given credit for this saying, but there's really no proof that he said it. But it's a great saying, and it's that history doesn't repeat itself, but it often rhymes.
Sure.
And we're definitely seeing, you know, some verses that sound a lot the same as the last ones.
Okay. Do you see any kind of good news in terms of like maybe when the market might turn around? Obviously, I think the market, you know, is always a little bit ahead of the economy because people are kind of trying to look ahead.
Oh, definitely.
So is everything kind of baked in for investors? Like, should we start buying now because all this fear is already baked in and it's peak fear, or should we wait a couple more months? What's your strategy on this right now?
I mean, that's definitely a tough question to answer. You know, I don't think that everything is baked in. And you're definitely right when you say that, you know, the market's a predictor. You know, it's a predicting mechanism. And they talk about the market as a discounting mechanism. And by discounting, they don't mean what most people think of when they hear discount, like, oh, that's on sale. But no, it's a discounting mechanism, whereas, you know, it basically predicts what something will be worth in the future. And then people decide what they're willing to pay for that now. You know, and that's what it means by a discounting mechanism. So you're absolutely right. You know, the market is predicting the future. And right now, there's actually a big fight going on. You know, there's a fight between people who think that the future is going to be a lot worse and people who think that, like, maybe we actually have hit a bottom and we're about to come back up. Now, me personally, I don't think that we've hit a true bottom. But at the same time, I've never really tried to say that I'm in the business of timing the market. You know, I have an algorithm that times the market for me, and it does a much better job than me.
Sure.
You know, so me, I'm looking at, you know, what are these things going to be worth 2 years down the line, 5 years down the line.
You're still thinking long term.
Definitely. But I mean, if you're thinking, if you really want to put money to work right now, then my recommendation is definitely big and boring. For now, big and boring. I love giving people small stocks that could just explode through the roof. But in a time like this, people want stability, and big boring companies like Apple and Amazon and Microsoft, they give that kind of stability. I really like cybersecurity right now. Cybersecurity has not penetrated the market very much at all, and you've got a lot more connected devices now than we had even 2 years ago before the pandemic hit.
Sure.
And I think cybersecurity is going to be big, so I think that's something to be looking at. But
so I agree with you. Actually, I kind of like the idea of software right now because a lot of the I feel like we're about to enter what's an earnings recession, where a lot of these companies their throughput costs are through the roof. But with a software company, it's kind of like those costs are still relatively low,
right?
And they can maintain those things. So I like software right now. Speaking of rotating, what should investors be looking at specifically in terms of like maybe actual parameters? Like if I were to run a stock screen, what are you looking for? You said big companies, so like large cap, but are there any other like key indicators, financial indicators of a company that investors should be looking for right now?
I mean, right now, obviously you hear it a lot in the news and everything that the growth trade is over, that, investors are looking for value, investors are looking at fundamentals. And I mean, honestly, cash flows are big. If a company has positive cash flows, then it's going to be able to get through anything.
Sure.
It can support itself. It doesn't have to take on debt. It doesn't have to sell new shares. So positive cash flows right now, companies that have a net profit, companies that return money to shareholders too.
Yeah.
Income's going to be very, very important. One, if we do have a recession, there's going to be layoffs. I mean, there have already been layoffs. They're already announcing more. Companies that laid off 20% of their workforce in January are making plans to lay off another 10 to 20% now. They're planning for a deep recession.
Sure.
And I mean, if you lose your job, When daddy doesn't work, mama doesn't get paid. So, you need a way to have something that you can fall back on, some income that you can rely on that like you're not working for,
Sure.
And that's definitely something that we're really focused on in the wealth advisory. That's one of my investing services. And actually, I've got a special sort of thing that I've put together about that. Basically, I've gone back and I've compiled all of the research that I and my team have ever done on income producing opportunities, and basically picked out the best income producing opportunities that we've been able to find. There's 9 of them, and
you also have a book, right?
And there's also a book.
Okay.
It's called Endless Income, and it's basically, I think that's about 33, maybe 34 ways, but more than 30 ways to basically like make more money, keep more of the money that you make, protect it from the tax man, and to spend less, to be able to get things for free.
Sure.
Get paid to golf on some of the world's best courses, get paid to take vacations. And then just, be able to get that income and not really have to work for it.
So like neat little income tricks that people can use?
Little tricks that I, sort of picked up when I was working on Wall Street, working with like super rich people, the really wealthy, they don't necessarily get there by working for it, I mean, like, yeah, they work hard and they work for it, but they make their money work for them. So,
Sure.
If they find a way to make a little extra money on the side, be that, owning a restaurant franchise, or I don't know, maybe even owning a bunch of vending machines that sit outside
Sure.
of schools, they'll do it.
All right, so I guess we could put a link in the description for some of that information. I also wanted to ask you a little bit about, you mentioned this algorithm that you use. And we kind of were talking about like parameters. That's something that investors should be looking for. Can you maybe give us a little bit of detail about this algorithm, what parameters it's looking for, and just tell us a little bit more about that?
Definitely. So, I mean, this algorithm, it all sort of stems from my time on Wall Street. I started at Morgan Stanley like in the depths of the 2008 financial crisis. So when I started there, I had basically just watched my parents, my friends' parents, older friends of mine lose like 75% of their retirement savings. And then I went to Morgan Stanley, and I watched my bosses cashing, gigantic, multi-million dollar bonuses from the bailout packages that they got from the taxpayers, which were my parents and my friends' parents and my older friends, and even me at the time, So I was like, wait a minute, like retail investors just got screwed, and now they're bailing out the guys that screwed them? Like, no, this isn't cool. Like this can't last. this will not stand,
Yeah, sure.
And it was just a slap in the face. It was a real slap in the face. It really woke me up. And so I stuck around Morgan Stanley for long enough, basically, to learn what I needed to learn, to pad my bank account a little bit because the pay is pretty good in an investment bank.
Sure.
But when I left, I left because I decided that wasn't for me. That, at Morgan, we always had a way to make money or make sure that our clients made money. And usually that was by taking advantage of somebody else. And that's just not what I wanted to do, because we were taking advantage of the retail investors, the ones that bailed us out and gave my bosses multi-million-dollar bonuses. And so, what we were doing, the data that we had really allowed us to have an advantage. And so I sort of started looking at the data and looking at, what we were doing with that data at Morgan Stanley. And when I left, I decided I wanted to basically create what we were using there, but for retail investors.
Sure.
So I worked with some of the best programmers out there, people that have worked for some big banks, major corporations, designing trading systems for them. And, we really, basically what we're looking for here is momentum. We wanted to use those big banks' data against them the way those big banks use our data against us. And those big banks have to report their trades. They have to. So we've got their data and we can see what they're buying. We can see if they're moving into
Sure.
the stock or if they're moving out of a stock.
And the algorithm is responding to this on a weekly basis, a daily basis?
So we run the algorithm pretty close to on a daily basis, especially in markets like this. On a weekly basis, it's going to give us new trades.
Okay.
But we'll run it, sort of on a daily basis, especially when, like I said, when the market's, really iffy like it is now, really volatile, just to sort of see if any of those signals that it's giving us have changed throughout the course of the week.
And how has that been performing in the current environment? I mean, the S&P 500 is down. Last I checked, it was down 22%.
Yeah,
year to date. So
year to date, S&P came up a little bit. S&P's down 20% year to date. The Dow's down about 15% year to date, and the Nasdaq's down 28.5%, almost 30% year to date. I know this because I literally just shot a TWA top 10 where I was mentioning that, how rough the markets have been. And I actually just did a recap for the subscribers of my algorithmic trading service. Since we're coming in to close out the first half of the year, figured let's see how we did in H1.
Yeah.
And the portfolio took a big hit the past couple of weeks. I won't lie. But we are beating the markets by over 200% this year.
Wow.
So you've got the markets dropping a lot, and we're able to outperform them like that. And so that means that over the course of the year we are down a little bit. But
sure, it's
as
all
soon as
it's
these
all
markets,
relative.
It is. It's all relative. So with the markets down 30%, with the Nasdaq down 30%, we're looking at maybe a 4% loss.
Yeah.
But when the markets turn around, you think about that 200% outperformance of the Dow. The Dow's been the outperformer this year. It's been the best index out of the three.
Yeah.
It's fallen the least. And we're beating it by about 212%. So when the Dow goes back to earning 8 to 10% a year, we're going to be looking at, 100 to 200% a year.
Sure, that makes sense.
So I'm pretty pleased with how it's working. It's basically doing exactly what I intended it to do. It's protecting our money during a market downturn, and it's going to help us grow it when the market goes back up.
Okay, that's really exciting. There's a topic that I kind of wanted to maybe push off to another podcast, but I think you had sent me some information the other day, and I kind of wanted to just touch on it real quickly before we kind of close this out.
Definitely.
And that is and I just think because it's really timely, and that is the helium shortage that's going on right now. And I saw an article that was essentially talking about how, I guess, Harvard University has had to halt certain studies because they don't have this critical resource of helium. And it's, helium is not something you normally think of. People think of lithium or cobalt or gold or platinum or, all these other resources. Very rarely do people think of actual gases. But you have, you have some insight on this and actually a potential stock play on it. So maybe you can give us some more information on that.
I do. And I got to tell you, I'm really happy to have seen that article recently because people have been laughing at me for a couple of years now when I've been telling them how expensive helium's going to get and how stupid we're going to feel for blowing up party balloons and making our voices sound silly.
Sure. I actually had the idea to kind of start this podcast off with a helium balloon, and I was going to, but it just didn't work out.
I would have given you a hard time. A year or two from now, that balloon could be worth $1,000. And I'm serious. So helium, people don't think about it. People really only think about helium as like the thing that goes in like the Macy's blimps and the stuff that makes balloons float and makes your voice sound silly and everything. But helium is used as a lifting gas in industrial applications because it doesn't compress very much. It's hard to compress, so they can push it through. It doesn't get taken down to a liquid. It's used in deep freezing things. It's the only element on the planet that can be cooled to like such a low temperature. It's used in making MRIs. It's used in making silicon chips.
Sure.
So like Silicon Valley literally can't exist without helium. And I've been talking about it for I want to say 2 years, 3 years now, because back. Gosh, it's been a while. It's been almost 20 years since they did it. But the United States used to have the biggest stockpile in the world of helium, right? Like so much that we provided the majority of the world's helium, something like 60% of it. And the government decided that helium was cheap and it wasn't really worth that much and we didn't need a stockpile of it. So they sold the stockpile off on the open markets for less than what the cost of helium was at the time.
Okay.
So now our stockpile is basically gone, and we're reliant on countries like Russia and Qatar and China and basically countries that don't like us or countries that are not very stable to get our helium. And we need helium.
And is that kind of what's causing the supply crisis right now? Is it the situation in Russia, or is there other stuff going on?
Partially in Russia, because Russia's one of the biggest exporters of helium, and there was a fire at one of their plants, and so their helium, like their biggest helium exporting, plant had to shut down. So it basically just like knocked everything off the market. Sure. And honestly, with all of the, what's it called? Things that we're doing to Russia. Like all of the things
sanctions.
The sanctions. Yeah. Thank you. Just the word was escaping me. It was like right on the tip of my tongue. But yeah, with all the sanctions on Russia, I mean, even if they were able to produce it, would we be allowed to buy it? Who knows? Probably not. Maybe if it was really that desperate, you know. But yeah, that's got a lot to do with it. You've got the supply chain crisis is making it tough. Like I said, countries like Qatar are supplying our helium, and that means we've got to get it out of the desert, across a bunch of oceans to Silicon Valley, to use it, or to like these places, to the MRI machines, to the lifting facilities, to Harvard, so that they can run their physics lab.
Okay. And look, I don't want to give up too much information because I know you have paying subscribers, but have you already recommended the stock around there, or you have?
So I've uncovered a company. There's a couple of companies that are working on it, but basically, after going through all of them, I found one that they basically have the largest reserves of clean helium.
Is it a domestic supplier, or where?
It's somewhat domestic, somewhat not. It's a North American supplier.
Okay, sure.
So, it's here, it's
domestic.
safe. They have, some stuff in Canada, some stuff in the U.S.
Yeah.
But basically, they have the best business plan. They've got, great data to go out and find it. They've got proven reserves, and the reserves that they have are clean, where it's helium. It's not mixed with anything else. They don't have to separate natural gas out of it. They don't have to separate toxic, chemicals out of it. They can just get that helium and send it right out.
And where can investors get that information?
So that one is reserved for the readers of my Future Giants newsletter.
Okay.
It's in Future Giants we invest in small companies that we think are going to be able to make a big impact on their industry and become huge in the future. Future Giants.
Sure.
This one, this one really hit the nail on the head, and I've been looking for a nice pure helium play for a while, and when I found this, the property and the data that they had in Canada was great. They just started expanding into the U.S. They're expanding their American footprint now too. So not only did we have it originally in a friendly neighbor close by, but now we're going to be getting it here from the U.S. And that's what we need. We need these domestic supplies, or we need to be getting them from close to us, from our friends, from people who aren't going to just be like, hey, you know what, you can't have that anymore.
Okay, well, that's all some really interesting stuff. Definitely not something that you're going to kind of read about in Bloomberg necessarily.
Oh, definitely not. Maybe in a couple of years after this company has already taken off and solved the problem, you'll hear about it. But no, nobody's talking about this helium thing because nobody wants to get laughed at like I've been,
Yeah. Well, look, we appreciate the insight and kind of like that obscure stock market story that you always bring to the table. We're going to wrap it up. We'll leave some links in the description to APM, to TWA, and to Future Giants for anybody who's interested. And if you're watching the video, like, subscribe, all that good stuff, and we'll see you next time.
Very cool. And Jason, I just want to thank you. And if I could put this out there before we go, with the Wealth Advisory, I compiled all of those income opportunities for everybody. But I also understand that times are tough. Everything costs a lot more. And I don't want to add to that burden. So I'm doing what I'm sort of calling recession pricing, or maybe it's pre-recession pricing if we're not really in one yet.
Sure.
But basically, I usually offer the Wealth Advisory for about $250 a year, which honestly is a deal. It's a discount. But when, it might cost you $250 to fill up your gas tank next week, I feel like that's asking a lot for people. And I'm also asking them to commit for a year.
Sure.
So I want people to have the benefit of the Wealth Advisory, and I don't want them to have to worry about not being able to buy food, not being able to buy gas. So I'm gonna do something new, and I'm offering the Wealth Advisory on a sort of a trial basis, a monthly subscription for $9.99 a month. Less than $10 a month. And if you'll have the first month to try it out. If you don't like it, I'll give you that $10 back. If you do like it, you'll be on for as many months as you want to be, and I'll never charge you more than $9.99 a month.
Well, look, I think, during a period of inflation, that's very kind of you,
I try to do what I can, I want to help. And, charging people an arm and a leg isn't going to help them.
Okay, well, great. Well, look, seriously, check out Jason Williams, and, check out his publications. Really smart guy, has a ton of great insight, and we'll see you next time.
Thanks, man. Check out Simpkins, too. He's a smart guy.
Simpkins is